In 2024, the total value of everything India exported to the rest of the world, every car, every microchip, every barrel of refined oil, came out to roughly $778 billion. Now, imagine a single mid-cap jewelry firm based in Bengaluru called Rajesh Exports looking at that massive national total and making a startling mathematical claim that they alone accounted for $158 billion of it. In local terms, that is over 15 lakh crore rupees. There is just one problem. According to a preliminary report by India's market regulator, SEBI, 99% of that staggering revenue might be a complete fiction. Claiming to represent 20% of an entire nation's total exports without showing the physical business to back it up goes against the basic logistics of the physical world. If you move $158 billion worth of goods, there are shipping containers, stacks of invoices, and physical footprints. This kind of accounting discrepancy creates real victims. Those seemingly incredible revenue figures acted as a magnet, luring in thousands of everyday retail investors who bought into the company's stock based on a mirage. The illusion even pulled in the state-owned Life Insurance Corporation, or LIC. They poured vast amounts of public money into the stock. When the market caught wind of the discrepancies and the stock crashed, investors were left holding a collective loss of over 12,700 crore rupees. The highly publicized success of Rajesh Exports functioned as a very efficient mechanism. It took real, hard-earned wealth from the public and transferred it into a corporate void. To understand how regulators miss this, we have to look at the founder, Rajesh Mehta. He carefully cultivated a public persona of an ascetic, traditionalist billionaire. Media profiles highlighted his simple lifestyle, noting he drove a modest Toyota and worked off basic push-button phones instead of expensive smartphones. But that media-friendly narrative masked an aggressive, hyper-complex reality behind scenes. While he was projecting an image of simplicity, his company was busy executing deals like purchasing a massive foreign gold refinery, using hundreds of millions of dollars in pure cash. This branding acted as a psychological shield. By presenting himself as an honest, austere traditionalist, he created an environment where investors and regulators implicitly trusted him, effectively bypassing the standard due diligence you would normally apply to a global conglomerate. The structural anchor for this entire operation was placed in 2015. Rajesh Exports bought Valcambi, a prestigious, massive Swiss gold refinery, which instantly gave the Indian firm an air of global legitimacy. Then they created a structural loophole. They inserted a middleman holding company, Global Gold Refineries, squarely between the Indian parent company and the actual Swiss physical refinery. Rajesh Exports eventually claimed 99% of its revenue came specifically from this middle entity. Yet for years, they ensured it was never audited. When Indian watchdogs finally asked for the books, the company's legal defense was to cite Swiss privacy laws. They weaponized foreign jurisdictions to prevent anyone from verifying if that middle company actually did the tens of billions in business it claimed. To see how his worked on paper, look at a transaction involving a company called Affluence. Rajesh Exports recorded 11,000 crore rupees in sales to them. However, no corresponding money ever entered Rajesh Exports' actual bank accounts. When SEBI investigators went straight to Affluence to ask about the deal, the client confirmed they had absolutely no business relationship with Rajesh Exports. This suggests the opaque Swiss structure was designed specifically to invent ghost clients. It allowed the company to generate massive on-paper revenue to keep the stock price up, without the burden of having to provide physical proof. You might expect a discrepancy of this scale to be caught by government audits, sophisticated trading algorithms, or the finance ministry. Instead, the catalyst for the entire investigation was a single email sent by an anonymous retail shareholder in March 2024. This chart compares the company's claimed revenue against its actual cash deposits. The shareholder spotted a glaring red flag in a metric called trade receivables. These are simply funds a company claims it is owed. As you can see, Rajesh Exports logged massive amounts of receivables over a 2-year period, but the actual cash never arrived in their bank accounts. A financial discrepancy scaling to 20% of national exports was cracked by someone doing basic public accounting logic, while the state's entire regulatory apparatus slept through the alarms. This raises serious questions about the competence of institutional investors. Why did LIC maintain a 10% public money stake in the company, even as its stock price plummeted by 70% and crucial audits were actively withheld? Or take the role of state banking. Canara Bank issued over 500 crore rupees in loans to a company that flatly refused to provide basic financial transparency to regulators. Ultimately, the failure points straight to the top. The finance and corporate ministries compile the very data used to measure the nation's economic health, yet they completely missed a 15 lakh crore black hole sitting squarely in their own export figures. India's financial ecosystem was built to protect everyday retail investors from corporate deception, but in this case, the system meant to act as a shield functioned instead as a rubber stamp for a multi-billion-dollar illusion.